The trend in recent years shows that only those cooperatives that regularly follow all financial indicators and perform effective business planning are able to work successfully and continuously in the changing economic situation and during the period of great competition. One of the elements of successful planning is careful risk analysis and planning of risk prevention measures. Because cooperatives are a relatively large business system, they are more exposed to risk than small businesses. Therefore, it is important that cooperatives assess their risks, including financial ones, in a preventative way, and develop a plan of action to prevent or reduce risk. Financial risks are different types of risks that, in the worst-case scenario, result in financial losses. Some financial risk is related to changes in the financial markets, such as changes in exchange rates and interest rates, while some is related to changes in the commodity market, such as commodity price changes and demand imbalance. There are also risks associated with decisions made by the management of the company, such as liquidity risk. Liquidity risk is the risk when a cooperative's short-term financial liabilities exceed its cash resources. If a company is unable to cover its liabilities with available money, it must reduce spending, generate additional income, sell fixed assets, which means a reduction in equity, or otherwise reduce the gap between available funds and short-term creditors. To assess the liquidity risk, the liquidity coefficient is calculated by dividing the current assets by the short-term creditors. The coefficient should be between 1 and 3. If it's less than 1, then there may be problems in settling short-term liabilities. If it's more than 3, that indicates an irrational use of current assets. The desired factor is also determined by the specificity of the industry. Credit risk is the risk that a cooperative's debtors will not be able to settle its liabilities with a cooperative. Such a situation can lead to a negative impact on a company's cash flow and its ability to settle its liabilities, which in turn may lead to liquidity risk. As a result, the amount of debtors and the payment terms have to be monitored regularly. Cash flow risk is the risk that the fair value of the receivables, creditors, future income, and expenses will be different from that at the time of valuation. The risk is caused by changes in market conditions, such as price, demand, and supply. Financing activities are activities for attracting finance for the operation of the company. It is usually necessary to decide on the source of the finance to be used, equity or creditor, or to attract investors, or to invest in increased equity, or to raise loans from financial institutions and increase the amount of creditors. When choosing a loan, the company takes on the debt, but the owner of the company does not have to reduce the number of shares. When attracting additional financing through the sale of equity, the loan does not have such a strict repayment schedule, and investors are more interested in the long-term success of the company. The loan is repaid through dividends. Often companies use both sources of finance. More risky transactions are financed by an increase in equity, while loans are used for more predictable transactions. Price risk is the risk of a fall of product price on the market. The risk may arise if the market price of the marketable product is lower than the planned sale price, or the price for which the purchasing agreement with the suppliers has been concluded, or, in the case of a cooperative, with the members of the cooperative. If a cooperative's products are traded on a stock exchange, it is possible to enter into different types of financial contracts. Currency risk refers to companies trading in different currencies. As a result of exchange rate fluctuations, the expected transaction value in local currency may be significantly lower than planned. To mitigate this type of risk, it is possible to purchase futures contracts for a certain amount of foreign currencies at a fixed price at a specified time. In order to minimize the risk of financial loss, companies take financial risk management measures. Financial risk management involves identifying, evaluating, and mitigating potential risk sources in the case of risk occurring. For risk hedging, companies often choose different types of financial instruments that could protect them from significant losses if the risk materializes. And in summary, first of all, any cooperative is exposed to financial risks. However, with proper preparation, the damage from these risks can be significantly reduced or even prevented. And second of all, if a cooperative does not carry out preventative financial risk analysis, it exposes itself to the risk of bankruptcy. Now here's some questions for discussion. First of all, what kind of risks do you think cooperatives are most likely to face? Second of all, which risks do you think are most damaging to cooperatives? And third, develop a short risk assessment for your cooperative by determining the probability of the occurrence of the risk and the extent of the damage in the 5-point system, and name the preventative measures.